Alright, so guys, welcome to part 7 of our higher time frame series. This is Dean here, covering the higher time frame series, and today what we're going to be doing is fundamental analysis. So what I decided to actually was to incorporate music kind of into the videos, right? So that way you don't really get kind of bored listening to me talk. And you can easily grasp what I'm saying as there's music in the background to, help keep you from sleeping or getting bored whilst I talk. Right, so with that being said, let's do that topic real quick. Today, what we're going to be focusing on is high attention to the maybe some 4 high attention to the arrays, part 7, higher time frame series. And real quick, let's start with support resistance, the classic retail support resistance, right? So, what is support resistance? Because I know every single retail trader who gets taught how to trade or who learns from somewhere how to trade needs to learn what support is and also what resistance is. So, let's ask ourselves this question: what is support and what is resistance? And is there really a support or resistance in the marketplace? These are the questions we need to ask ourselves, and these also are the questions we need to answer. We're going to answer this in the next couple of minutes. So, without anything much else to say, let's get into today's session: PD arrays. First of all, starting with resistance and support. So now, what I want us to do is let's imagine a range, a price range. Right, so we'll put these 2 arrow bars together to indicate that this is a price range. And maybe we could, let me edit this. So let's define a range. Define price range. Okay, define price range. Make this font a little bit smaller, and there we go. Right, so now let's assume this is a defined price range. Defined price range moving from support to resistance. Okay, so now if the trend was a downtrend from somewhere to the left of the screen, something we can't really see, okay, if the left was a downtrend, then the price gets to a higher time frame support level, price would make a bounce off that level. So once price gets to a higher time frame support level, it's going to make a bounce off that level. And that bounce is what we call point of origin. That is the start of that move. That is the start of the bullish move, right? So we'll call this point of origin. Okay, and what that simply means is around that point, or even if there's a small little range around that point. Okay, let's say small little range like a 15-minute range or a 1-hour range, right? So even if there's a small little range around that point, we call this the point of origin, meaning that around that zone or around that point was where the central banks came into the marketplace and bought up the market. Because if the market is going to make any major turning point, okay, on the higher time frame, that is caused by the central banks. That is caused by the institutions. Okay, so if it took something to change the market basically from a downtrend all the way up into an uptrend and reverse the entire market, then the people who reversed the market bought into that bearish market basically around the point of origin. So that's what we're going to use to reference as a support level for the potential new range being formed, which is from point A to point B. Okay, so now as price makes a move away from the point of origin, as indicated by this extrapolated move in the market, then you're going to get a corrective market structure. Now the market is going to correct off the heels of this bullish move, as there's going to be some form of late fund buying. So some of you guys might ask this question: what does G mean by late fund buying? So late fund buying simply means that the hedge funds, right, would not get into this buy move around the point of origin. Okay, the hedge fund would not get into that buy move around the point of origin. The hedge funds will see the move late. Let's call this retracement. So the hedge funds are going to see this huge big move late, right? What basically is going to happen is, as price makes a move from the point of origin, the hedge fund looks at this as, okay, price is reaching for resistance. And what they will then do is try to buy up the market at the worst point possible after the market has made a move. So once the hedge fund comes into the marketplace trying to buy up the market, the central banks sell to the hedge funds. So the results of the central banks selling their assumed buy positions around this level, okay, that is what offers liquidity in the marketplace. That is what gives liquidity in the marketplace, buying and selling. Right, so if the central banks are now selling to the hedge funds, that is going to cause the market to retrace, because now the central banks are selling a portion of this bullish position. So as the central banks sell to the hedge funds, they book a profit of this move. They book a profit of this buy move by selling to the hedge funds, right? So the hedge funds buy the market around this level. Central banks sell, 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 sell. Once price gets to a discounted level once more, central banks buy the market, right? They buy up the market. Market moves higher, keeps moving higher, but the market gets to a form of resistance where it will then find a reversal of some sorts to go bearish. Okay, so this is basically how a range works, whereby central banks begin the move, then the funds try to participate in the move lately after the market has made a move, basically. Okay, and then the central banks basically continue that move until they get to a level where they want to change direction or change the marketplace. So once price gets to resistance, price taps that higher level resistance, makes it a pullback, right? And then you say a small little retracement to try to get back to that point. So this small little retracement is what we covered on institutional swing point. This is what we call a failure swing. So let me highlight this real quick. This is what we call a failure swing. This is often common around market turning points. Okay, make this be kind of light. Okay. All right, so this is what we call a failure swing, which is often common around market turning points. So for reference, go back to video 5, where I covered institutional swing points to understand how the central banks and the funds trade around reversal levels, which then gives rise to institutional swing points, which is the breaker and then the failure swing. Okay, so around this point, price will try to attack that level once more to give the central banks more opportunity for them to sell into this move, right? So as price is moving away from resistance, price is going to find the midpoint of the range. So now the question is, how do you get the midpoint of the range? So the first thing you need to do is to identify a predetermined price range. So you need to get a predetermined price range, meaning a swing high to a swing low, or a swing low to a swing high. This is exactly the same way you want to draw a Fibonacci. Actually, the same way you're going to want to draw a Fibonacci on the price chart to identify a leg in price. This is the same way you also want to do that for a range. So a range simply is a leg in price. Okay? So leg in price could be a price range. So what you simply want to do is you want to identify the top of that price range and also the bottom of that price range to give you a defined range where you can work within. Okay, and now remember, all what we're doing on this session is all higher time frames, meaning the monthly, the weekly, and daily. So once you identify your range, you simply pull out your Fibonacci and then you draw up the Fibonacci from the top of the range to the bottom of the range, and then you get your midpoint, which is your 50%. So your 50% right now would be the midpoint of your price range. Okay, that will be the midpoint of your price range. Alright, so should price get to the top of that range, meets resistance, we know price is going to want to seek for or seek support basically. So once price makes a turning point around this resistance price point, we know price wants to reach for support because price is always constantly undulating between support and resistance. So as price drops to the midpoint, price is going to make a retracement back up to the last mini low to find more resistance, and sales will come into the marketplace. Price makes a retracement once more, looking for resistance. So basically, in this move from resistance all the way down to support, all you're looking for is a resistance level on the price chart to sell into in line with institutional order flow. So this typically is the way a range works. This is the way the market moves in ranges. From the level of support to the level of resistance, from level of resistance all the way back down to the level of support. But now the big question is, does support and resistance really exist in the marketplace? Do you anything such as support and resistance? Okay, let me give you a while to digest that thought. Okay. So, is there anything such as support and resistance? What is actually support and resistance? Is support and resistance true in the marketplace? Does support and resistance exist in the marketplace? That is a very big question. Does support and resistance exist in the marketplace? And that is what we're going to answer, because what some of you guys get taught is support and resistance, support and resistance, support and resistance, and everyone wants to buy off support, sell off resistance. But I want to tell you right now, that is actually false. There's no such thing as support. There's no such thing as resistance. That is all retail BS. Resistance through the marketplace. Okay, so that is all retail BS. Excuse me for that. Okay. So now let's go to the real deal. Let's go to the institutional aspect. Because what I just showed you, everything I just showed right now, is the way the retail traders view the marketplace. This is the way when they come into the marketplace, they view this as support, view this as retracement back to support level, resistance, all the way back to the midpoint of the range and all that. Okay, now let's go to the real institutional terms. When I mean real institutional terms, I'm talking about the way the central banks view price. What is the true way the central banks view price? How does the central bank really view price? Okay, so here we come to expensiveness and cheapness. So I'm gonna write that down on your notepad. Expensiveness and cheapness. The way the central bank view price, they view price as either expensive to buy or either cheap to sell. That is the only thing you need to know about price zones, expensiveness and cheapness. Alright, so now the first thing we want to do to identify expensiveness and cheapness, basically let's get the concept out of the way real quick. Let's get you guys to understand the concept of expensiveness and cheapness. So now let's take for example you got an iPhone, right? An iPhone 11 Pro. Let's say it retails around $1,000. iPhone 11 Pro retails around $1,000. You got about 10 iPhone 11 Pros, expecting to sell them off. And now you know next week, by next week the price of the iPhone 11 Pro is going to drop to $500. Sorry, not actually $500. Okay. So you know the price of the iPhone 11 Pro is going to rise, not drop actually, it's going to rise to $2,000. You probably get inside information, or Apple sees, okay, the price is going to $1,000 this week, and next week it's going to be $2,000. And then you go and you buy the iPhone, expecting that by next week, price of the iPhone, of one iPhone 11 Pro, okay, is going to be retailing around $2,000. So now let me ask you this question. Would you actually sell that iPhone that same week when you bought the iPhone for $1,000? Would you actually sell that for $1,000 that same week, or would you rather prefer to wait until next week to sell the iPhone for $2,000? You know, 100% of the comments is going to be, or 100% of the answers is going to be, definitely I'm going to wait until next week, right, to sell the iPhone for $2,000, because that is going to make me money. Because that's basically what everyone wants to do. Right, so that is going to make you money, and that is why you bought the iPhone. So you're buying 10 iPhones, right, for $1,000 each, which is going to be $10,000. And by next week, when the price of iPhone gets to $2,000, you can then sell off the 10 iPhones and make $10,000 extra on the iPhones you bought. So that is simply what you simply did there. That simple analogy is you buying the iPhone while it's cheap, expecting it to be expensive the next week, all right? So you can sell. Predetermined price. Okay. So all you simply did there was you did what the central banks do. You did what everyone does. You buy something when it's cheap, you sell when it's expensive. This is why the true range in price is cheapness and expensiveness. Nothing more. There's no such thing as support. There's no such thing as resistance. Although you could use those terms basically, but there's no such thing as real support or resistance in the marketplace. All you can find in the marketplace is all cheapness and expensiveness. Okay, so now let's say for example you are you're holding, right? Let's say you're holding BTC, you're holding Bitcoin. And currently now Bitcoin is retailing around let's say $7,000 per BTC. And then you know by next week, you've done your analysis by next week, if you want to sell off your Bitcoin, it is going to be retailing around $5,000. So now the big question is, would you actually sell your BTC right now when it's $7,000, or would you wait until next week to sell it when it's $5,000? Obviously, everyone would want to sell it at $7,000 because they know if they hold that BTC until next week, they lose money because the value of the BTC then drops whilst you're holding BTC. So this is how you can all relate this to expensiveness and cheapness in the marketplace. So what the central banks basically are doing is central banks coming to the marketplace into price and buy your price when price is cheap for them to buy up relative to a range, to a predetermined price range. Then they sell the market when it is expensive relative to a predetermined price range. So I'm actually getting the spelling of predetermined wrong. So let's see. Predetermined. Yeah. Predetermined. We correct? Why am I getting this wrong? Oh. Yeah, so predetermined. Right, so let's get back to the middle of the matter. So let's make this smaller. Okay, so now the next question you want to ask is, so Jin, I get all what you're saying, right? I get you talking about expensiveness, I get you talking about cheapness, and it all makes sense. But now, how do you actually apply this to your chart work? So now this is where it all comes, where the institutional reference points all come into play. So by the way, if you're wondering what an institutional reference point is, refer back to the PDRA video. I covered everything in detail with institutional reference points. Okay, so now institutional reference points basically are the clues the central banks give to the marketplace, where they would want to trade the market to in the future, either as a continuation move or as a potential reversal in the marketplace. Okay, and what are institutional reference points? Right, what are the examples, or what are all the institutional reference points? So basically, there's 1, 2, 3, 4, 5, 6. There's about 6 to 7 institutional reference points. I mean, true levels in price where you can see that there was central bank price action or there was IPDA involvement around those price points. So this is where we come to hold high, bearish rejection block, bearish order block. No, actually, let's remove bearishness or bullishness. Okay, let's just identify those levels. So for institutional reference point, you've got hold high, hold low, rejection blocks, order blocks, fair value gaps, liquidity voids, a breaker, or a mitigation block. That is all you need to know in reference to a institutional reference point. So hold high, hold low, rejection block, order block, fair value gap, liquidity void, a breaker, or a mitigation block. Because now remember what I showed you guys the previous video, whereby you identify a range and then you pull up your Fibonacci to find the midpoint of that range. So that is basically the same thing you want to do. So you want to identify your range, right? Once you identify that range, you pull up a Fibonacci to get the midpoint of your range. So anything above the 50% of the midpoint is called expensiveness. At that point, you don't really want to focus on buying. Okay, unless if price hasn't gotten to your to an institutional reference point on the expensiveness level or on the premium area. Okay, so around the above the 50% of the range, you really want to focus more on sales, or you really want to begin to anticipate sales. Okay, so there's lots of factors that could come in to change that. But basically, this is a general rule of thumb whereby once price breaks the 50%, you know price is going to reach for one of the institutional reference points on the expensive side, which is the premium area. And what do we have as institutional reference point on the premium area? So we've got basically in order of appearance. So take note of this. Okay, in order of appearance on your chart, you've got old high, sorry, old low. So if price is moving from a discount area up to a premium area, from cheapness to expensiveness, right? So the first thing price is going to approach, should that be there, is old lows. Once price goes past old lows, the next target is a bearish breaker slash mitigation block. Okay, so now let me put an area real quick. So now let's see price moving from discount level to a premium level. I'm going to make this point. Okay, so the first thing price is going to approach is old lows, should that exist on your chart. So once price goes past old lows, the next thing to reference in terms of institutional, okay, institutional landmarks, let me call it that way. Okay, institutional landmarks is bearish breaker slash mitigation block. Should that exist? Should that appear on your chart? Should price go past this level, the next thing to reference would be a bearish liquidity void. After that, bearish fair value gap. After that, bearish order block. After that, bearish rejection block. And lastly, we got old highs. So old highs, on terms of expensiveness, is the most premium price level you can get. Also, if you refer back to institutional swing points, I tell you the best moves in the marketplace where you can get the most minimal surpluses for the biggest moves. Okay, often around old highs and old lows. I don't call it now, the extremes of the price range. So on the extremes of the price range, you've got old highs on the premium side and then old lows on the discount side. These are the extremes of the price range. And now let's assume price is moving from a premium level to a discount level. Okay, let's say price makes a reversal of a bearish order block. Then what you're going to where price you want to seek for as potential target would be, in order of appearance on your chart, would be old high. Next up would be bullish mitigation block slash breaker. Next up would be a bullish liquidity void. After that, bullish fair value gap, and then bullish order block, bullish rejection block, and on the extreme side of the range, you've got old lows. That will be the last portion of that move on the reference in terms of a cheap or discount area, basically. Okay, so the question now is, how do you utilize premium area and discount area? Right, so you can often use them to find entries on the higher time frames. Okay, when you're looking for sell moves, you want to look for any of these institutional reference points on the premium side to sell off of. Okay, so if you see that there's a bearish fair value gap, but there's no bearish liquidity void or no bearish breaker slash mitigation block, okay, and price has just traded past an old low, right? You can use this as a level to sell off, expecting the market to fill in that bearish fair value gap and make a potential reversal of that level, because that is where the central banks will look at price as expensive to sell. So remember, if price is expensive, you want to sell. Remember our example of BTC at 7,000 versus BTC of 5,000 the next week, right? You want to sell BTC whilst it's still more expensive at 7,000 versus holding that BTC when it's 5,000 the next week to sell, because then you lose money. But if you're selling whilst it's 7,000, right, so then you potentially make gains or you keep some profits basically. Okay, so that's exactly the way the central banks view price. So what they basically do is, off one of these premium institutional reference points, they're going to sell the market, or they're going to come into the market and push the market down by placing blocks of sell orders around that price point. And then once they sell at a premium area, this is where you then use the idea of PDRs. You can use a discount area as potential targets. So the good thing about PDRs is you can use them as entry levels. You could also use them as target levels. Because now, if you're selling from one of the premium array, price is going to reach for a discount price one, because the central banks would not want to move the market all the way back up until it gets to a discounted price point. And what is a discounted price point? You can see ODI, bullish mitigation block, in order of appearance on your chart. So hopefully this all makes sense. So you can use one of these levels for sells to sell into the marketplace. If you identify institutional order flow is bearish, then you can use one of these levels as take profit. So now let me give you guys an example. Right, so now let's say the market goes straight to a bearish fair value gap, fills out that bearish fair value gap. You actually saw that, you think, oh, this is a good level to sell actually. So let me sell the market around this price point. So you sell the market around that price point. Price begins to trade down. So what do you do in terms of target projection on your higher time frame? So the first thing you want to do is, where is my next discount price point? If there's an old eye existing around that level, that will be your first take profit. Because that will be the first level where you want to see price trade to. And price must definitely trade to that level, because that is the first discount level. Then should price trade to that level and go through that level, the next reference point will be, where is my next discount array where the central banks want to reach for as a potential fulfillment of the sell moves around the bearish fair value gap. So you can say the bullish mitigation block / breaker. But now, if oftentimes you're not going to really see a mitigation block or even a breaker on your chart, so you can skip that. If the bullish liquidity void exists, use that as the next target projection. If that does not exist on your chart, then you reference the next one, which is a bullish fair value gap. Then you keep doing the same thing until price finds support around one of those levels. So thus, the true levels in price isn't support and resistance. True levels in price is expensiveness and cheapness, because this is the way the central banks actually really view the marketplace, via premium array and a discount array. Okay, so now, okay, this is actually satisfying. Okay, so lastly, how do you apply the concept of PDRs to your charts before we go into examples? Okay, so the first thing you want to do on PDRA is you want to identify a predetermined range. Okay, so first of all, you want to look for a predetermined range in price. So identify a predetermined range. Then next up, probably you could take a screenshot if you write all this down, so that we never miss that. So should you want to apply PDRs in trading, basically, when we begin to piece everything together, and this is the concept we're going to use, right? So we're going to do this on a rule-based basis, but we're following rules strictly. Once we create a new concept, we give a set of rules to follow to apply that concept. So that way, no one gets confused. No one begins to ask questions. What do I need to do? What do I need to do first? What is the first thing I do? So the first thing you do when you want to draw a PDRA is to first identify a range, identify a price range. Same way you're going to want to draw a Fibonacci from a swing low to swing high. That is exactly the same. It's as simple as drawing up a Fibonacci, right? So for you to draw up a Fibonacci, we're actually doing first identifying a price range. Okay, now that's exactly the same thing you're doing with the PDRA concept. Only different right now is you're doing this on the higher time frame. Okay, you're drawing from a daily swing high to a daily swing low, or a daily swing low to a daily swing high, depending on the institutional order flow of the market. But then the next step is to identify the midpoint of the range via the 50% Fibonacci. So once you get a range, swing low to swing high to swing low, then you drop a Fibonacci from the top of that range to the bottom of that range, and then the midpoint of that range becomes your equilibrium. So you label that equilibrium. Okay, so let me actually forgot to place this. So let's see. That is okay. So that is an equilibrium price range, meaning that is the midpoint of that price range. Equilibrium midpoint. Okay, so the next step you want to do is price values above the midpoint is considered expensive that is where you want to sell. Or should you be a buyer from a lower level on the range? That is where you go to look for as a take profit level. Number 4, price values below the midpoint is considered cheap. That is where you're going to want to buy the market in line with what you expect the central bank to do. Or should you already be in sales from a higher point on your range? You're going to look at a discount level of any price value below the midpoint as a level to sell into as target projection. And number 5, you identify institutional reference points on both sides of the range. So you identify the bearish institutional reference point on the premium side of the range. You also identify the bullish institutional reference point on the discounted side of the range. Then number 6, you identify institutional order flow to determine direction. So you identify what trend is the market in. So the market actually in the bullish trend or is the market in the bearish trend. That is what you want to identify, and then you want to trade in line with institutional order flow. So if the market is in a bearish tone, you're more likely to get sales of premium levels to trade into discount price points more than you're likely to get buys of discount price levels to basically take profit around premium array or premium price levels. Basically. So in the bearish market tone, you're looking for I say sell from expensive. Yeah, basically. So that is number 7. You sell from expensiveness to cheapness in the bearish order flow. Okay, so if the market tone is bearish, you're looking to sell from a premium PD array, from a premium array actually to a discount array. And then if institutional order flow is bullish, you buy from cheapness to expensiveness, meaning you're going to buy from a discount PD or discount array. And I keep saying PD array. Okay, so you're gonna buy from a discount array, and then you're looking to take profit around premium arrays. Right, so what we're going to do now is we're going to try to apply this PD array concept in 2 examples, and then after that you can do your homework trying to apply the same concept basically. So what we're gonna do first is let's look at recent price action. Right, so this is USD CHF. So let me do something like this real quick. USD CHF. So let's do this. An example. We're gonna put the market around this level. Right. So let's see. This is USD CHF on a weekly basis. So now what we want to do is we'll identify the top of the range and the potential bottom of a range where we can look for price action around that range. So now, first I want to pay attention to real quick is notice how price broke out of the low of this range. So now that automatically invalidates this low. Okay, so this is no longer going to be considered the lowest point of the range. Because now price is traded through that range. So you're going to find the next reference point in terms of price, which is this low, this last swing low. So once price breaks through this range, we're going to reference the next swing low, which is this. So price break through the swing low, we're going to reference the next swing low, which is this. And you're going to keep doing the same thing until price finds support around one of the discount price points. So ultimately, this low swing low is invalidated, so we're not going to consider that a range. But like look at price made a turning point around this level. So the top of that range is a premium price level, okay? Because the central banks for some reason consider that price expensive. Actually, if you look at price now in terms of this range, this initial price range, right? To pull up a Fibonacci and reference this. So now if you're drawing up your fibs, you want to draw from the body, candlestick's body to the candlestick's body, okay? Especially on the higher time frame. So look at this level actually. Let's actually pay attention to this before we go into next level. Right, so look at this level, right? This is the midpoint of the range. The midpoint of that range. Let's identify the top to the bottom. Okay, so let's close this. This is the midpoint of the range. Put this out. Bottom of the range, swing low, top of the range, swing out. Okay, so let's actually do this. That is actually a good example. So we can then remove our Fibonacci, because now we have the on top of it. So price clearly is on a downtrend, right? So now let's go back to what is our, so identify a predetermined range. That's what we actually did. Swing high, swing low. Next step, identify the midpoint of the range via the 50% Fibonacci. That is equilibrium. Okay, so what we just did was we drew up a Fibonacci, we brought up the Fibonacci to the midpoint of the range is here, which you can see differentiating price. Now we've identified equilibrium, so we can simply label this EQ. EQ stands for equilibrium, and then can label this premium. Anything inside the green box is considered premium. Then we can consider this discount. So anything inside the purple box is what we call discount. So discount level, premium level. Now we've identified a premium level, we've also identified a discount level. Now the next step is to price values above the midpoint is considered expensive. So anything in the green zone is expensive. You want to look for sales. You want to focus more on sales in the green zone. Okay? Then price values below the midpoint is considered cheap. Discount. Anything below this midpoint is cheap. Okay, so below this midpoint you want to look for more for buys than sells. Okay, but now remember we've identified a price range. So now let's go to the next step, which is identifying institutional reference points on both sides of the range. So in terms of identifying the institutional reference point, all you're simply looking for is where price can potentially trade into and then unfold orders around that level. So now the first thing I want you to do is let's go back to our premium array chart. Okay, so now let's look at the arrangement. Oh, this actually went up. What I was trying to move was this. That's okay. Let's see. So we did up this to 121. I think that is the midpoint of the range. What is this? Lower portion of the range. Okay. We have this. Basically. Right, so now you look at the order of appearance of a premium array, right? The first thing you have is old lows. Okay, so now if price move from discount level, now you're looking for sales in line with a bearish institutional order flow. Right, the first level you're looking for where price could potentially reach for is or sell from is old lows. Now let's answer this question. Is there any old lows on USD CHF? Not really. Really not any old lows around USD CHF. So we scratched that out of the books. And now the next thing is a bearish breaker slash a mitigation block. Now the next question is there a bearish breaker slash a mitigation block in price? Yes, there is. As a matter of fact, there is actually a bearish breaker. Look at this equalize, right? So equalize in price. Equalize in price. What was the last bearish candle before price took out? This equalize 1, 2. So these two candles were the last bearish candle. That becomes our bearish breaker. So this is our bearish breaker slash negation block. So this is the first level we can expect price to sell away from. Should price keep past that level, what you would have done, okay, should price have skipped past that level, traded through that level, is you have to solve this question. Is there a bearish liquidity void in marketplace on that price pair? No bearish liquidity void on the weekly time frame. No bearish fair value gap also on the weekly time frame, right? And then there's a bearish order block, which is this. This candle is bearish order block. Okay. But you can't really expect price to reach for that level as price has efficiently traded all inside this range. Okay, so for those of you guys who are so confused about efficiency, okay, go back and watch my video on PDRs. Okay, it's on the higher time frame 2 section. Go back, watch the video on higher time frame PDRs. Okay, so now what we would actually want to reference is these two last down candles, which is our bearish breaker, and basically we're going to identify that range. So what I'll do now is I'll try to get the midpoint, okay, the mean threshold of the bearish mean threshold of the bearish what's it called, breaker, right? So the mean threshold of bearish breaker is the 50%. We're going to extend that line out in price, and boom, look how perfectly price respects the bearish breaker midpoint. Bearish breaker mean threshold, price respects that level. So now what we simply did was we identified reference point on the discounted, on the premium basis, and expected that if to price trade into that level, the central banks will want to come around that price point and move the market in line with institutional order flow. So now remember, price just broke market structure. So now institutional order flow is bearish. Because now if prices went through this level, what can we reference in terms of discount array or discounted price point? So this is where we go to old high. So I'll ask yourself this question: is there any old high in price around this level? No, not really. No old high in price around this level. Okay, so we skip that. That's missing. We go to the next question. Is there a bullish mitigation block / breaker around that level? Let's check. No bullish mitigation block / breaker around that level. No. Also, no bullish mitigation block. No breaker around that level. Let's keep that. So this is the way we begin to frame our trades and expect price to trade off that level. So now we know price is respecting the midpoint of the bearish breaker. Now we're trying to find a target where price could reach for. Okay. So the next question is there a bullish liquidity void in the marketplace where price could reach for to find support? No, not really. Price has efficiently been traded on the downside, so no real liquidity void. Also, there is no real fair value gap in the marketplace. Price has efficiently been traded to the downside. So the next thing we can actually reference is a bullish order block. So is there a bullish order block in the marketplace? Yes. What was the last bearish candle? This was the last bearish candle. Okay, this candle, the last bearish candle. Now we simply extend the line out from the open of that last bearish candle. That is going to be our first take profit. So if we're selling from the premium level, our target projection first off would be the discount bullish order block. Okay, on the discount array, that will be our first target projection. Then the next up will be the bullish projection block. The projection block basically is equal body candles, right? So equal body candles, as you're seeing, this 1, 2 candles. That is our projection block. That is what we're going to look at as the next target. So price trade through this discount, okay, bullish order block. Okay, and then that is our ultimate swing. And then, actually ultimate swing. The last one we're going to reference in terms of institutional reference point on a discount basis would be old low. That is going to be the last thing we're going to want to reference, which comes in form of this last bullish week. And that will be our ultimate target projection in line with institutional order flow. So hopefully this all makes sense to you guys. Thank you all for being a part of this, for going through this video. Actually, keep saying this like it's a webinar. And I'll see you guys in the next video. Make sure you stick through this and you apply that to your charts. And you make sure you also study the concept and go through that on your charts to have them basically reinforced in your mind when you're seeing them on live chart. With that being said, good night everyone. See you next time.